The economic tsunami, 5 unseen triggers that could crush your finances. I hate to say it, but right now, most people are financially exposed and they don't even know it. We are not talking about inflation or interest rates. We are talking about 5 hidden triggers that are lining up right now that could wipe out years of your savings in a single afternoon. If you're not ready, these next few months could cost you everything. And the 5th trigger? It involves a $37 trillion time bomb that the government is trying desperately to keep quiet. Stick around, because this is exactly what you need to prepare for, and I'm going to show you how to profit from it. What's up, guys? It's Oscar here, and for years, I've told you that smart investing is boring investing. But lately, watching the market operate has felt less like investing and more like a trip to Vegas. Today, we're breaking down the 5 unseen triggers, from market concentration issues to secret geopolitical plays, that could cause a serious financial correction. I'm going to reveal what each trigger is, why it matters to your bank account, and exactly what you need to do immediately to keep your money safe. First, let me give you a quick roadmap of what we're going to cover. We will start with the deceptive comfort of easy borrowing, move to global supply shocks, look at the surprising truth about where all the stock market profits are actually coming from, examine the danger of speculative betting, and finally, we will talk about that monster debt figure, where I'll give you 3 steps to get prepared. If you want to keep your financial house standing, pay close attention. Let's get right into trigger number 1. Trigger 1. The illusion of easy money. The first warning sign is sitting right in our pockets. Credit is drying up. Now you might think, Oscar, I don't rely on credit, but trust me, the health of the lending system impacts everyone. Think back to the last few years. Money was practically free. Interest rates were microscopic, and credit card companies were throwing lines of credit at anyone with a pulse. This created a feeling of widespread wealth and overconfidence. People felt secure spending freely because borrowing was cheap. But that cheap money allowed many people and companies to live way outside their means. Now, that party is ending. Credit scores are dropping at the fastest rate since the Great Recession. And private credit, the money non-banks lend out, is shrinking fast. This is important because when banks and private lenders get nervous, they tighten up. It's like a garden hose being pinched. If the water stops flowing, the credit, the whole garden, the economy, suffers, and quickly. Why does this matter to you? When people can no longer rely on cheap debt, spending slows down, company profits drop, and the entire system slows down with it. It reminds me of exactly what happened right before the 2001 dot-com crash. The average person doesn't notice this until they apply for a car loan or home equity loan and get denied or get stuck with a much higher rate. But by then, the slowdown is already here. So, what do you do about this credit squeeze? Simple. You need to become the strongest fortress in the economy. This is not the time to be financially sloppy. First, pay down high-interest consumer debt aggressively. If credit card interest is eating up your budget, you are building your financial house on sand. You need to clear that foundation. Second, build your cash reserve. If credit access disappears for a few months, you need to be able to cover your expenses without panicking or selling off investments when they are low. I always keep some extra cash on the sidelines, just in case we see a drop and there's a good buying opportunity. This might sound boring, but practicing good financial habits now, in both up and down markets, will save you 10 times over when the market gets difficult. Now, talking about things that are difficult, we have to talk about something happening globally. This is trigger number 2, and it's a shock that hits everything from your smartphone to your electric bill. Trigger 2. The global supply chain chokehold. We rely on a ridiculously fragile global system to get pretty much everything we buy. And this system is currently dealing with geopolitical friction that has the power to stop the manufacturing world cold. I'm talking about rare earth minerals and export controls. You might remember earlier this year when there was escalating tension between the US and China over tariffs. The US enacts tariffs to try and bring manufacturing back, China retaliates with its own tariffs, and the market drops severely. Now, the new tactic being used is export controls on rare earth minerals. These aren't just obscure science experiments. These minerals are used in everything: your phone, your computer, missile components, electric car batteries, and advanced factory equipment. And here's the kicker: 90% of these rare earth minerals are processed in China. China's government says implementing export controls on these items is normal practice because they have dual-use properties for civilian and military applications. But let's be real. This is a highly calculated chess move designed to weaken the US economy by threatening to cut off the supply of parts needed for 90% of our modern technology. It's a game of chicken, and the global economy is in the middle of the road. If China fully restricts access to these elements, the cost of manufacturing new technology goes through the roof, production lines stop, and inflation on manufactured goods becomes far worse than anything we have seen lately. We saw a similar dynamic play out with tariffs leading to one of the worst stock market drops since the Great Depression. This threat is even bigger. Why should you prepare for this? Because you can't rely on global supply chains staying smooth forever. You need to focus on things that are insulated from this global friction. My action item for dealing with the supply chain chokehold is simple: invest in redundancy and essential services. Think about companies that produce or source materials locally, or focus on services that cannot be outsourced or stopped by a trade war. If you're investing in manufacturing, favor companies that have complex supply chain diversification or rely less on imported specialty parts. This is where researching the supply chains of your holdings comes into play. It sounds complex, but just look for companies building things closer to home. The current system is like a Jenga tower, where if one piece, like a rare earth mineral, is pulled out, the whole structure could wobble or even collapse. We are looking for things that aren't on that Jenga tower. But even if global trade settles down, the stock market has a major hidden issue brewing, which brings us to trigger number 3. This one explains why that rally you've enjoyed recently is a lot more fragile than you might assume. So stick with me, because the next point is the only way to safeguard your long-term portfolio. Trigger 3. The illusion of market stability. Have you noticed how strong the stock market rally has been recently? Everything seems fine, right? Well, that stability is an illusion built on a shockingly small number of companies. I'm talking about market concentration. The concentration of wealth and value in the stock market has reached historic levels. Just consider this. Tech now makes up more of the S&P 500 than the peak of the 2001 dot-com bubble. The top 10 companies now make up more than 40% of the entire index. If you own a broad index fund, like the S&P 500, congratulations, you're investing in the best strategy. But you're heavily reliant on 10 companies continuing to perform perfectly. This market structure is incredibly fragile. If one or two of those behemoth companies get hit with a regulation issue, a sales slowdown, or just a bad earnings report, the shockwave hits the entire index because they hold so much weight. It's like having a dozen healthy horses pulling a wagon, but one horse is 3 times bigger than the rest. If that big horse trips, the wagon rolls over. Legendary investor Paul Tudor Jones even said that the nervousness we're seeing today is reminiscent of exactly what happened right before the 2001 dot-com crash. And the Buffett indicator, which measures the total stock market capitalization compared to the economy, recently hit its highest level ever recorded. This implies that the market is one of the most expensive it has ever been. So, the stock market appears to be operating on borrowed time, just waiting for a reason to begin selling off. How do you protect yourself from market concentration? First, keep investing boring and simple. Study after study shows that the best investors simply buy a broad index fund and hold it for 20 years. Don't overcomplicate things. Second, and this is important right now, consider diversification beyond the standard S&P 500. While dollar-cost averaging into the S&P 500 remains a smart move, this is a good time to look at small-cap and international index funds. Small-cap stocks are companies that aren't in the S&P 500 and are often overlooked. They carry risk, yes, but they are not reliant on the same 10 massive tech companies that are driving everything else. Think of it as balancing your portfolio so that if the big horse stumbles, the smaller horses can keep pulling the wagon forward. I've made my share of mistakes, but staying consistent with simple, diversified investing has paid off massively over decades. But speaking of risk and fragility, our fourth trigger is entirely self-inflicted by investors trying to get rich too fast. This is the leverage time bomb, and it's why certain parts of the market can crash 50% in an hour. Trigger 4. The leverage time bomb. If you've ever watched your investment account drop 5% in a day and felt sick, imagine watching it drop 50% in 30 minutes. That is the reality of the leverage time bomb, and it's something that is propping up large segments of the stock and crypto markets right now. We recently saw the largest single-day cryptocurrency liquidation in history. Bitcoin saw its first ever $20,000 red candlestick, and leverage traders lost their fortunes almost instantly. This happens because of leverage. Leverage allows people to put down $1 and control $100 worth of an asset, 100 times leverage. Here's the math. Simply put, if you invest $1 with 100 times leverage and the market goes up 1%, you double your money. Sounds great. But if the market moves down by just 1%, you are completely wiped out. Why does this create a time bomb? A large portion of the market is propped up by these highly leveraged trades. When the markets fall even slightly, those leveraged traders are forced to sell immediately or get liquidated, causing the price to fall even further. This triggers more liquidations, forcing prices down more, wiping out even more people. It's a vicious, self-reinforcing downward spiral that happens in minutes. This is why investing should be boring. It shouldn't feel like a lot of fun, and if you're trying to beat the market using risky bets, you're taking a risk that you could lose just as much as you gain. I truly think the line has gotten way too blurred between calculated risk and pure gambling. The best advice here is always to avoid taking unnecessary risk. So, what's the action item here? Stay away from unnecessary risk. If you're using high-leverage trading platforms, stop. If you are day trading meme stocks based on Reddit posts, stop. If you are looking at your portfolio and thinking, I could lose this, but I could get rich tomorrow, you are gambling, not investing. Instead, prioritize the boring stuff. Dollar cost averaging, buying broad index funds, and living below your means. Trust me, over decades, most people who take unnecessary risk will look back and just wish they had kept it simple. This leads us to our fifth and biggest unseen trigger. It's the elephant in the room that every politician is trying to ignore, and it's the long-term threat to the entire system, the $37 trillion debt reset. Trigger 5, the $37 trillion debt reset. This is the ultimate long-term financial tsunami warning. Our national debt is staggeringly high. While nobody knows the exact breaking point, the threat of how we deal with this enormous number is the biggest systematic danger we face. Forget what you see in the news every day. People are openly talking about a $37 trillion debt reset plan. That is a terrifying idea, whether it's done through inflation, through defaulting on some obligations, or through something more extreme, like slowly erasing the debt with gold and cryptocurrency. The problem is that the only way to manage this debt is either through massive growth, massive tax increases, or simply devaluing the currency, which is just another word for severe inflation. Any one of those options causes major, unpredictable economic turbulence. We are living in a time where anything could happen with no warning whatsoever. You need to stop worrying about the day-to-day market noise, which is just white noise, and focus on the decades-long strategy. Why does this make a financial tsunami likely? Because when this debt issue finally forces the government's hand, the instability will likely cause a market bottom defined by absolute investor capitulation. That's the moment when everyone thinks the market is doomed forever and is never coming back. That is typically the best time to buy, but you have to be prepared for it. So, if you're concerned about this debt time bomb, what are the 3 steps you should take right now to prepare for a $37 trillion future? Step 1. Increase your defensive assets. This means assets that tend to perform well, or at least survive, during high inflation or instability. Historically, this includes things like real estate and physical assets. When I first started buying real estate in 2011, people were telling me it was a bad time. But I kept going, and now those properties are worth much more. I'm not saying real estate is guaranteed, but owning tangible assets can act as a great defense against currency problems. Step 2. Stay invested, but have dry powder. I know it sounds like a contradiction, but here is the data. Half of the S&P 500's strongest days in the last 20 years occurred during a bear market, and another third took place in the first 2 months of a bull market before it was clear the bull market had begun. If you miss the top 10 best trading days over the last 5 years, your return drops from 15% to 3.75%. You cannot afford to miss those days, and the best days often come right after the worst days. So you stay invested, dollar cost averaging on a schedule, but you keep a little extra cash ready for when the inevitable scary drop happens. When you see that moment of absolute panic selling, that's your window to invest. Step 3. Keep it boring. This is the most important piece of advice of all. Avoid the noise, stick to broad index funds, and ignore the urge to gamble. The stock market can remain irrational longer than you could remain solvent. Your goal is to be financially secure, not to get rich next week. In conclusion, these 5 unseen triggers, the credit squeeze, the supply chain chokehold, the unstable market concentration, the leverage time bomb, and the debt reset, are all warning signs that we need to take seriously. They are all pointing toward a future where being financially conservative and patient will pay off more than ever before. The market is going to keep doing what it does, but you need to control what you can control: your debt, your savings, and your investment strategy. If you focus on those 3 things, you will survive this economic tsunami. Speaking of surviving a market crash, I've broken down exactly what the wealthiest investors, like Warren Buffett, did during the last major recessions to set themselves up for decades of wealth. You need to know their moves right now. Click on this video right here to learn the simple steps the rich take when the market starts to fall, and I'll see you in the next one.